Hey, everybody, welcome back to our panel discussions, which we've been doing for a couple of months now. I hope you've been getting some great insights from a lot of the different guests that we have. We're pretty lucky today. We have, as we were chatting before the panel, we have two guests. We all agreed we're not millennials. I'm not going to say how many years of experience. I'll maybe let them say that, but really a lot of years of experience in wealth. And we're going to dive in to look at a topic today on hyper-personalization. So let's dive into that, and we'll start with an introduction of the two guests. And maybe if I can ask first, Keith, just to give a quick intro to yourself, that would be great.
Yeah, hi, Keith MacDonald. I'm based in London. I look after the work we do at EY in the wealth management private banking industry. So that's the bank-owned and independent players, and I think importantly to this, all the technology and infrastructure providers that support that supply chain. So I've always been based in London, but many, many years, I think many is the appropriate word, isn't it, Ned? Working in this industry across wealth management and private banking.
Exactly, Keith. Correct. I think when I mentioned I was 54, let's just say we're all roughly around the same age, and we'll leave it at that. We also have Sameer Kaul. Sameer, would you like to give an intro to yourself as well?
Yeah, sure, Ned. I actually have about 25 years of experience in the wealth management industry. I spent 23 years working for Citi in India. The last 6.5 years, I ran the private bank in India. And now I actually run our own wealth management practice called Trust Plutus. Plutus actually is the Greek god of wealth. So there is some correlation in terms of the name of the firm and what we do. But it's a very interesting business. I'm sure Keith knows this very well too. I think once you get into it, it's difficult to get out of it.
Yeah, I think it's true. I did not. Well, I've definitely learned something today. I did know Plutus was the Greek god of wealth. I'm always finding out that the Greeks had gods for everything, so I assumed they did have a god of wealth. I just didn't know it was Plutus. So I'll take note of that. Great. So just as a summary today, so what we're going to be looking at is how to transform financial advice hyper-personalization. If we can dive in just on the slide to the summary that we have. So on the summary of the problem, there's quite a range. I think we all understand that and I think as Sameer was saying, once you're in wealth or in finance, it's hard to get out of it. But I think we understand today that it's changing completely. And what we're going to look at today is this hyper-personalization. And we'll dig into what that means. But, customer first, but how do you deal? Every customer's always had their own wealth problem. But in today with technology, how do we correctly deal with that? So let's dive into the three questions, and we'll start with the first questions that we have. So here are the three that we're going to go through. So we're going to look at the different thoughts on the increase in personalization financial advice. We're going to look at some examples of what can work in the future, and then we'll basically talk with Keith and Sameer about what actual practical stuff they've done there. So going through the first question, and maybe Keith, I can start with you. As you said, you've been in the wealth space for a long time. You've seen it change. Being at EY, you've obviously worked with a large range of different clients. When we think about personalization, as you mentioned before, JP Morgan with Nutmeg and different clients, everybody's kind of jumping in to be part of it. What are your thoughts of that in the financial advice space, Keith?
Well, it's interesting you use the word recent in the question. I mean, the last 16 months have thrown so much up in the air in every aspect. And I think it accelerated an awful lot of things as well as caused a lot of issues. I think a lot of the acceleration of the digitization of this has been part of that as well. So I think it's raised a load of questions for companies of all shapes and forms, but also for customers as well in terms of their own financial positions. Inevitably, these sorts of economic problems throw that up in the air anyway. So I do think recent, if we'd asked this question 18 months ago or maybe 2 years ago, we'd have probably had very different answers to what we're looking at now, particularly when we look forwards. So I think point one is it's all up in the air, and there are patterns coming through, but some of these patterns are still quite difficult to pin down, particularly about which players are playing with which services in which markets and types of clients, be it ultra high, family office end, all the way through to mass affluent.
And
I was going to say, I think the second piece of that is the definitions of some of these terms. Advice as a term under different regulatory environments means very different things. I mean, if I look from a UK perspective, advised and non-advised or guided, there's a load of debate around what those terms mean. And they're also point in time terms. You know, a piece of advice now could be execution only, but in a context that actually could bring different types of implications further down the line, be it tax or others. So I think, you know, not avoiding the question, but when you start unpicking the question, there's an awful lot of complex elements to it,
I think it's really good about patterns, but also about segments. It's a really good point. I mean, again, I don't think we have the exact answers. Sameer, I mean, as you mentioned, you were head of Citi Private Bank. So obviously you've seen the high net worth. And sometimes I think personalization is assumed that, oh, it's just millennials with their, first time investing app. But in reality, I mean, I'd be interested in your view. Everybody wants a personalized service. And of course, there's been the high touch for personalized wealth. But as we do it in the technology wealth, what are your thoughts on that, particularly perhaps in that high net worth space? Oh, I think you're on mute. Sorry there, Sameer.
Sorry, I think it's a very relevant question because my experience, Ned has taught me that I think the client expectation is more towards a build to suit model than a model which is like a bank going and just selling products. I think today we deal with different profiles of customers. Somebody who's lost a spouse has a different mindset towards investments versus somebody who's a young millennial who's just generated liquidity versus somebody who's planning for retirement. So I think the reason, at least I see in India, that money is moving away from the money center banks towards firms like ours is because our approach is to basically customize the solution for each customer and not go with a product approach. So I think that the build to suit, the flexibility, the business model, banks tend to still follow what I call the distribution model, where they work on retrocession from third-party managers, which, as we know, is not always the best model for investment products and for wealth management. And of course, the most important thing is that in the kind of practice that we are seeking to build, like you see in a developed market, maybe in the UK or in the US, the continuity factor only comes into play when people come and work with firms like us, like ours. Otherwise, traditionally with money center banks, everybody is looking for the next job, the rise in hierarchy, the next location, the next, when will I become MD and stuff like that. Now that in our business is not relevant because the client expects continuity. The client expects that when you actually say long-term, you mean not just long-term from the point of view of how much time it will take for the product to deliver, but also your commitment to our relationship.
It's an interesting point, that continuity, because you're right. In the old school world, a relationship manager or a wealth manager leaves a firm and takes his clients with us. Is that a reality in the new technical world, the new digital world? Because somebody's going to say, look, I'm still using this digital platform. It's an interesting point, that kind of continuity side of it.
Because I think that you may call me old school, but the fact of the matter is that I see in this business that the trust factor comes with the individual who's serving the client, right? And I don't think you can ever replace that. You can complement the effort of the individual through technology. But to say that, listen, in the ultra high net worth space or the high net worth space, I will completely eliminate the human and I will only work with a robo advisor. I think from where we are today, it's a bit far-fetched. That's my perspective.
I kind of agree. I do think it segments. I think in the high net worth or whatever number that is, you need a human with digital. But I think, and maybe, I think we're straying on to the next question, but we'll hold off on a minute. And maybe, Keith, your thought, because I think a millennial now doesn't need, whether they do, but they don't expect a human touch within their digital app. But I wonder if they do as they, in the next 5, 10, 15 years as they go forward. Keith, what's your view from that side that, you know, is it as segmented as that? There's a certain number, and then high net worth, and you have to have humans, and there's a certain, not, I'm sure it's not as black and white as that. But Keith, what have you seen in that area?
Yeah, I mean, there's a whole mix of aspects to this. It's life events, it's propensity to use these tools, it's the amount of time people have as well. I mean, if you look at segments now in terms of the fintech wealthy, if you like, so potentially asset rich, cash poor, but there's a load of different elements to how that market is segmented, all the way from mass affluent through to ultra. And the idea of, we quite often look at this as individuals, but there's so much of this now is around families and multi-generational, not just sort of first and second, but extended families, godparents. It's, there's all sorts of different aspects to these relationships, which add to that time scale in terms of looking at how it works. But interesting what Sameer says. I think this is one of the $1 million challenges of the industry. There's so much M&A around, and M&A is driven on the basis that people and assets stick. But I agree. I think there's an element of relationship there that does mean that not everything will stick. But then certainly the bigger firms are looking at teams of people looking after different aspects of relationships, therefore protecting the brand versus just the individual relationship.
It's an interesting one because asset managers used to be brought for a few percent of AUM, 3, 4, 5% of AUM, yet digital wealth robos get brought for hundreds of percents of AUM. And there must be a different formula, whether it sticks or doesn't stick, because you're right. Like, you should be buying for customer base, but it seems that M&A has been turned on its head to a degree from that side. So it's an interesting from stickiness. I mean, we might just bring up the second question because that will lead us on to this. And maybe Sameer, to throw it over to you, like, how do we think about this going forward, personalized? So you talk about build to suit. I really like that idea. And maybe that's how we think about it going forward. Because, look, when I watch Netflix, I watch my Netflix, right? I don't really, like, I say this with all respect, doesn't really bother me what Keith or Sameer watches unless we watch the same, and then Netflix works out and tells me what to watch. But in theory, I watch what I want. How personalized? Because the reality is we all have our own financial problems and financial challenges and financial wins. When you say build to suit, Sameer, how do you predict that into the future? What are you thinking? What are you not dreaming up, but what are you thinking?
Well, I'm very strongly of the belief that no machine can replace the emotion that the human brings to the table. And I think our business is all about understanding emotion and building relationships. And that's why I think, fortunately, you cannot replace us with robots and with machines, right? Because I think the stage in life that different customers are only comes across when you really start to meet them and talk to them, and they become comfortable. They know they can trust you. A film star has a different perspective on his or her wealth management needs versus a footballer or somebody who's in the professional field, or somebody who's an executive in a firm. So I think that this personalization comes because of the need to understand human emotion, to understand greed and fear, to understand, what are your objectives. In a market like this, which is like going up every day, I don't think people give too much credence to these things, but we have seen these cycles so many times in the past 25 years that we know that the times will change, and we know that people who are advisors will be more appreciated when you don't have this one-way street in terms of how the markets are going up, and then there will be value attached to advice. But the basic question and the basic perspective, Ned, is that you cannot replace the human emotion and the ability to understand that emotion with a machine.
So you mentioned greed and fear. I used to work for a company called CLSA. They had a strategist called Chris Wood who put out a weekly greed and fear report. And he basically said, when it comes to wealth, there's just greed. And of course, he was summarizing, just greed and fear. But what he said is, we're all greedy at the wrong times and we're fearful at the wrrong times. We're greedy when markets are going up, when we should be fearful, and we're fearful when markets are down, when we should be greedy. How do we replicate greed and fear in a digital world? You're right. I agree. I don't think it's binary. I don't think we get rid of humans totally. I mean, Keith, what's that future of it? I agree. Like I'm absolutely not advocating we're getting rid of humans, but we are kind of supplementing them with tech. I mean, Keith, you definitely, I'm sure you talk to a range of clients. Actually, maybe to summarize Sameer's question, do you think the clients you talk to are fearful of the future or greedy in the future when it comes to digital and personalized wealth?
Well, that's a very, very different question. And I think it opens up a completely separate part of what's going on at the moment. There's greed and fear, but I think there's an awful lot of discussion and reality around purpose and broader issues. And that isn't just an ESG regulatory tick box exercise. That is a real challenge now coming in from an awful lot of people. I don't think I've never heard anybody saying they're afraid of the new technology. I think what it does is it facilitates these relationships. I think if you look back to last March, April, as everybody rushed to plug in e-signature tools because they had to, some of the traditional ways of interacting with clients were broken. And because they had to be broken, you couldn't meet face to face, so you had to use these tools. So all sorts of different people who had gone into the office to do it, et cetera, et cetera. So I agree with Sameer, but I think it's more complex than that. I think if you look at an individual or a family, a set of people over a 2, 3, 5 year period, I think the input measure approach in the past has been, look, we haven't seen them for 2 months, we must go and see them. I think now it's more about what are they doing, and if we need to see them, we'll see them, and if we need to get them to sign something, we'll ping them a note, and let's make sure they're getting information, probably digitally, about what's going on in the markets. But if something happens, I mean, similar like a project like a death or a marriage or something shifts and the transaction happens, that's when I do agree that the personal interaction happens. So I don't think this, I mean, we bandied this word hybrid around a lot in terms of personal and digital interaction. To me, that's not, it's always hybrid at each stage of each relationship and each thing. I think it's very much transaction and event driven. And I also think it's sort of, to throw it back to the personalization side, it needs to be a bit self-served as well. I mean, we talk about self-service in terms of completing data, making sure firms know enough about individuals and families about what they're doing. But that also can help trigger when the interactions and how those interactions should change as well.
But it's very interesting, Ned, if I can just add, just yesterday evening, we had a conversation with one of your colleagues at Bambu, right? And we talked about the fact that how we can look at potentially creating a digital end-to-end solution for clients who are our clients who basically buy mutual funds, right? And this is exactly the point I think that even Keith is making, that the digital capability complements the physical emotion and the human emotion, right? So one is not saying it's either or, right? One is saying that, listen, both work together. You want to call it hybrid, you want to call it complementing each other. Definitely technology has a role to play. I don't think that one is suggesting there is no role to play. I think it's a very strong role to play. But I feel that in a slightly more volatile marketplace situation, which it hasn't been for the last year or so, right? People will start to value advice. I mean, today people don't seem to be valuing advice because no matter what you touch, everything goes up in value, right? But I think when you get to a more saner situation, I think between digital and physical, it probably will complement each other.
It actually kind of, just a question maybe to both, well, Sameer, I think you've answered it. I mean, in reality, we've had a 10-year bull run in reality, right? Like, yes, when the pandemic hit, there was a slight drop, but I think I read the other day we're doubled from the S&P has doubled since then. I personally, I think if we'd had a 10-year bear market, robos wouldn't exist, or these self-trading apps wouldn't exist. They wouldn't have grown, because even if you're beating the market in the down market, no one's going to be happy to that degree. I'm interested in, you see, right now, everyone's a genius, right? Because as you said, Sameer, it doesn't matter what you buy, you're going up, and people are trading on Robinhood are geniuses, people who are in robos are geniuses, and everyone thinks, so they maybe don't need such personalization because it's all going fine. And when things are going fine, no one complains, no one says anything, right? Let's say markets, and again, I don't want to be doom and gloom, but what happens if we have a 5-year bear market, or even a 1 year, a 6-month bear market where it goes down? Well, I don't know, Keith or Sameer, if you want to answer that, because then I think personalization will massively increase because people will want to find out, hey, I'm using this digital tool or I need you. Where are you? I wonder if we'll see a massive increase in personalization if we enter a bear market.
Well, one of the things that I have seen is that unless you, of course, buy ETFs which replicate a broad index, but we see customers, for example, in India, who go and buy direct stocks. Okay, nothing wrong with that. But the question is that which stocks are you picking and what is your allocation in the portfolio? And then people don't pay attention to the fact that if your allocation, your selection may be right, but your allocation may be wrong. And then what happens is the mix of the two creates, in some cases, a suboptimal return profile for the investor. So when you talk about personalization, right, this is the other aspect that I may be owning Apple computers and Disney and what have you. But if I don't own them in the right percentage, and I'm not using ETFs to take equity exposure, it's quite possible the S&P is up 16%, my portfolio is only up 6%. And then the question is that, do you need advice or you don't need advice? And many people actually don't pay attention to these things because in their mind, I invested $100,000, it's worth $110,000, we're doing well. The families, everybody's happy. So I'm just saying that where people like us try and add value, because that's our job, is to ask some of these tough questions. And then we use technology to kind of help answer those questions.
Absolutely. Keith, any thoughts on that? Because I don't sit around and worry, because I've learned in life there's things you can worry about and things I can't worry about. A bear market, I just got to run Bambu. But Keith, what's your thoughts if the market changes and what happens to personalization?
Well, I mean, we're back in 2019, all those many years ago, that's exactly what we were talking about. What type of recession, what type of global recession were we going to get? And bizarrely, the horrendous events of the last 16 months, we seem to be now moving back into elements of bubble, but boom of one shape or form. I don't know. I mean, back to the exam questions you've set here. I think a lot of the discussion is around investment and mix of investment, but actually planning, financial planning, is almost more needed in a bear market than in a bull market, because that's when people have to make decisions. If you're surfing a wave in a decent market, then it's about allocation and risk and things like that. If you're looking at the implications of parts of markets in being in trouble, that's when proper planning comes into play.
And do you think so I'm totally agreed. Do you think the tools today can handle it? Have the tools been built, in essence, in a bull market? They are, the digital planning tools. Do you feel that they are correctly built to do the right planning? We will get a market that heads in the other direction. What's your thoughts, Keith?
Well, the maturity of technology in the wealth space is much more around the investment side and be it execution only or whatever. I think planning, goal-based planning, and some of these types of tools are earlier stage and actually behaviorally very, very different market by market. I mean, how, say, a US market or a US consumer looks at things like goal-based planning is very different to a sort of Anglo-Saxon European approach. So I think because of that, some of the tools in this space are early doors. And there are huge implications around taxation and local regulation and pensions, all sorts of stuff in the mix. So I think they're coming, but they've not been fully road tested yet.
Yeah, I think like any new industry, digital wealth particularly is new, 5-10 years, right? Nobody was using a robo 10 years ago, and only I don't know what percentage today. It's without doubt growing, but it's still small. And maybe if we just put up the next question, because that's actually looking at the specific use cases. Here we go. So I like your point, Keith. Exam questions. Sometimes I do deviate from them. So why don't we go for that, Keith? On this question, maybe I'll just hand it right over to you.
Well, this is always a fun one from my perspective, because we try to serve the whole market in this. So it's not just our organization, it's our clients. And I suppose we see the full spectrum. I mean, we see almost trying to rebadge investment managers as planners, which doesn't, that's I mean, I've shown my age by saying it's the old teller-seller debate. You can retrain, but it's a different discipline. You see different large and small organizations looking at how to manage a customer interface, customer relationship, and switching almost between planning and advised and non-advised, depending on stage of where the relationship is, things like that. So I think there are patterns, but there's a long way to go before it settles into, I think even within one country, it settles into a particular pattern, never mind when you start looking internationally.
And you've mentioned this term pattern a couple of times. I like that idea. Could you maybe highlight, it's like, again, it doesn't, I know that it, as you said, it is all up in the air, but when you think about the different patterns that you're seeing, is there anything that you see repeatedly as you stay talking to different clients that you would say is kind of first and foremost?
Yeah, I mean, in fact, I think what Sameer was saying as well, it's this use of technology to support the personal relationship and the personal relationship at the appropriate time. And again, back to what I was saying before in terms of this life stages and events that support it. So I think that's a pattern instead of trend, whatever we call it. That I think is one of the most positive things, that this concept of hybrid personal and technical support for individuals and families is becoming a real reality now. And how that actually looks in 2 years' time and 5 years' time, I think will depend on a whole set of stuff. I mean, we hardly mentioned data in these discussions so far as well. I mean, mixed views about artificial intelligence, analytics, and the use of analytics to support particularly more complex relationships and wealth management. I think there's a huge place for analytical tools and data in the mass market, mass affluent going into affluent. Trickier to use those sorts of tools to support more complex relationships. But again, it's shades of grey to me. It's not like, here's a set of tools for this part of the market, here's a set of tools for that part of the market.
I think we've only scratched the surface with data. I definitely agree in the mass retail. So partly at Bambu, what we're doing is trying to build something called predictive planning, which the idea is, how predictive can we be about financial planning? And the reality is, on average, for most people, it's a fairly set journey. Go to school, go to college, get a degree, start a job, get married, have a kid. Like it isn't random for every person. Of course, as you have more money, it gets more personalized. But you're right. I think compared to where other industries use data, I think in financial planning, we're absolutely only scratching the surface. I do think when a large industry tech player, be it a Google or a Paytm or a Ali or whoever, really starts to consume the data of the person, particularly their financial life, my thought is that in the end, investing becomes almost, you just click yes or no. The data will be crunched and it will say, this is the right plan for you based on people like you and all this average. And so I think you're right. I think data is like a whole discussion there. But Sameer, the question comes back to, the kind of customer engagement, and we use the word confidence in the institution. You use the word trust, same thing, right? Like I think that's without doubt. So, from what you're doing, how do you see that as an institution ensuring you have the right level of engagement and confidence?
I mean, I think in the last year or so, clearly the frequency of interaction has gone up significantly. I think the expectation is the content and the quality of thinking has to be right up there in terms of what we are kind of recommending to our clients. And I think, again, given the kind of, I would say, unnatural market conditions, right? The expectation is that, we need to be proactive. For example, I don't know if you guys are following what's happening, but India right now is just going through an IPO boom. Frankly, if I change the profile of my company to Trust Plutus Tech, maybe I could be valued at $1 billion or something like that, right? And I would go into an IPO. And I'm just kidding, but the point is that that's the way. We've seen this many times over. I mean, this perhaps is the kind of final nail in the coffin, so to speak, before the market changes color, right? But yes, I think client expectations are that there has to be frequent interactions. I think there has to be proactive interaction. You were talking about greed and fear. Right now, I think we see clients full of greed. And that's why nobody wants to book profit. And I know the day will come when the market comes down. And then they'll come back and say, listen, each time the market went up, it was our decision. And each time you did not make us sell, it was your decision.
Correct.
And once you get used to that ideology, you'll be a very successful private banker.
I think some things never change, right?
Some things never change. Some things never change.
It's true. And just thinking on that, do you today? It's an interesting point. You would have thought, and again, I think if we'd been asked in March of 19, how do we predict the pandemic to affect our lives and wealth? I think I certainly would have been pretty pessimistic. But interestingly, you see, we interact with clients more today, not less. Like, we're not seeing them physically, but we're interacting more, not less from that side. And I think you're right. Whether it's about them telling you brought or sold at the wrong time, how much is too much? Like, like they're going to call you when you missed something, and then they're going to say they did well. I'm interested in what is the right level? That's what I'm interested in. Personally, I've been trying to think about this because when we build robo-advisory solutions, you don't have to check your portfolio every day. Indeed, I think we've learned checking your portfolio every day isn't a good thing because you do too much. You should have longer term. What's the right amount of engagement? Sameer, any thoughts on that?
I think our promise to our clients is that we should probably do a quarterly review every calendar quarter, right? But I think one of the changes that have happened, Ned, is that there have been changes at the client end. So for what kind of changes? For example, people used to travel. They no longer travel, so they save the travel time, so they have more time on their hands. Some people have just decided, either it was forced on them or they've decided to take early retirement, so they have more time on their hand, right? So in that situation, people are actually reviewing their portfolios more often than they used to. And when they review the portfolios more often than they used to, then the expectation is that people should be available for discussion. But I agree with you that we dissuade clients from having very frequent interactions. We actually have a structured process around the interaction. So it is a review which is planned every calendar quarter. It doesn't matter if the S&P is 5,000 or 500, it doesn't matter. But yes, I think because of changes at the client end, because they now suddenly have more time, at least some of them, than they had earlier, we do see a lot more engagement from them than what we are used to.
Makes sense. Keith, any thoughts on that in terms of that customer engagement, maybe and across segments, but what's your thoughts on that? Because customer engagement has changed. Like, as you say, whether it's e-signatures, customer engagement has changed. Do you have thoughts about what is that right level or how you would advise somebody thinking about that?
Yeah, I suppose it's how do you define an interaction? Because if somebody, if the first thing somebody does every morning as they wake up is check their portfolio, that's an interaction. They're looking at your app, they're looking at your brand, they're seeing your business. They're just because it's not talking to an individual, so they would see that as an interaction with you as an organization. But I think this is back to a comment before about some of this stuff needs to be self-service. That it needs to be. People need to understand that at an appropriate point in time, this is the right way to engage with an organization, either personally or digitally, to do a certain thing. I think a lot of basic transactional stuff that used to be done through calls and things like that now can be done quite simply and technically, particularly payments and movements and even sales and whatever. I think it's more the richer interactions where the proper advice is needed. Again, as Sameer said before, that's where that's where the personal interaction can't be replaced.
Yeah, like it would be a great outcome if all the low value stuff was just automated and the high value stuff was more frequent and better. I mean, I think that would be a great outcome. 25 years ago, I was a financial advisor, or 30 years ago, probably now. And I remember even then thinking, this is remarkably inefficient. I'm like taking forms and I'm moving forms and I'm like I don't know what percentage of my time was inefficient, but it was high. I think if we use tech to make the human interaction high value and the low value stuff, that would be better.
Yeah, but it was also used as a way to engage with people. Oh, we've got to see you because you've got to sign this document, and here's 3 other things I want to talk to you about. Now, if that signature of a document is being done digitally, then you need to create a reason why you're actually talking to somebody.
But that goal-based investment, in theory, and to your point, Keith, about data, if you have the right goals. So again, look, I always have this idea. When Google launches a wealth manager, they're not going to ask you when you're getting married. They're not going to ask you if something happened. They know, right? They know everything. They don't need to ask you because they know when you're getting married. They know when you change job. They know when you got a promotion. They know everything, right? And then they will almost preempt it. Hey, I know you're changing jobs. You're going to get more salary. You're going to get a 20% pay increase. Let's put more in your portfolio. And maybe as we come to, I know we're almost getting towards the end of time, maybe as a summary, and maybe Keith, starting with you, how would you for me personally, I really do think that we are so early in personalization of wealth. I still think it's relatively rudimentary. And I don't know how far ahead we have to think because, as I mentioned, even a year ago, I wouldn't have where we would be today. So I hate to try and guess 10 or 20 years in the future because A, I'll be too old, and B, I don't know exactly. But as you think, as we wrap up the panel, maybe in just a minute or two, how do you summarize where you think personalization is going in financial advice?
Well, I mean, I think back to an earlier comment, I think what's happened in the last 16 months is some things have been accelerated by years. I mean, friends I know, they see 5, maybe even more years of acceleration into a year of some of the digital tools that are being used. Wow. So that, I think, is an upside of this, that it allows a very different pattern of interaction with clients. I come back to the point I made earlier as well about moving this from being about a client or even a traditional couple, whatever, into families and extended families and into relationships like that. Because I think that's a crucial part of it as well. So I think point 1 is the digital side is gone much, much quicker. The understanding that this is about multiple relationships, I think, has come earlier as well. A lot of off the back of this. But moving forwards, I think the key to this is this sort of hybrid word about when is personal interaction used, when is it supplemented and supported by other types of interaction, when is it self-service, and how do you spot the opportunities to build relationship. And I think one of the other key things is, and there are very few firms who are simplifying their set of propositions going to clients. They're either building out or creating marketplaces, bringing in other tools to support. Again, these trends have happened before we go back 20 years to the .com time. There were these sorts of models, but the technology and the data now can support those types of broader marketplaces to support these relationships as well. Makes sense. Yeah, that's a good overview. Sameer?
I actually, if you don't mind, Ned, I had a question for Keith, which is that across Europe, when you see how effective has been the robo-advisory kind of platform, especially in the private banking target market?
Yeah, mixed. I think I've used that word a bit, haven't I? Very early days. And the tools, I mean, some of these terminologies, robo-advice, reg tech, wealth tech, I think are getting used and abused. So slow. I mean, some of the major firms have built their own or are white labeling different types of proposition. But I've seen so many different types of technical proposition badged as robo that I don't think there's a sort of complete pattern to what's happening on that yet.
Because my understanding is that even Ned in the US, while you have companies like Wealthfront and what have you, right, who basically offer robo advisories, but I'm not sure how much is that impact, especially in this private banking kind of target market.
I would say this, in the private banking target market, slow. the digitization of process is high, but you don't call that robo. So digitization of transactions and signing forms, that's high. Robo, I would say it's growing strongly in the new sector. People who may not could have afforded a financial advisor, 5,000 to invest, 10,000 to invest. I think we're seeing that. I still think it's single digit percent, but I think it's opened up a new market. So I think for large banks, how much revenue is it putting in there? Not a lot, honestly. But the number, if you take a long-term view, 10, 20, 30 years, a customer with $1 million in 10 years' time would have grown up using a robo today at some point. That would be my theory. So yeah, if a bank just wants to make revenue from it, not so much. I'm guessing 5% of people in the US, 10% are full robo. Early days, but growing, but not so much in high net worth, more in mass affluent and retail.
So yeah, although there's an interesting.
Sorry,
go ahead.
Go ahead.
Say that there's other aspects of this. I mean, it's not just greed and fear; it's fear of missing out. So a lot of the execution-only tools, and the whole crypto speculation. There's some fairly unhealthy aspects to this market at the moment. So no advice at all, and people basically taking bets.
Yeah. So I guess maybe Ned, the millennial segment or the lower ticket size segment probably has a higher propensity to go and use a self-service robo-advisory platform, which is my experience so far, which is the reason I asked the question to Keith in terms of his experience in Europe per se. But I guess the future very much is about a hybrid kind of a model where, if firms like us ignore digital, probably it's at our own peril. And I think we will never probably, at least in our lifetime, see a situation where you can eliminate the human element of it, especially in the private banking segment. So it's going to be a hybrid kind of model, right? Which I think will make sense, at least for firms like ours.
I think I heard somebody categorize it as, what is the right amount of digital wealth you need? It's not 0%, it's not 100%, it's somewhere in between, right? So we're not going all digital. We're not, if you have no digital, then I think that is pretty terminal for your business. And again, whether that's in India, UK, USA. Great. Well, guys, thank you. Look, I know we're up on time. Really appreciate your thoughts on this. I think as we go forward on the whole digital wealth, again, partly we are kind of working it out as we go along, but with your experiences, yeah, it will be great to kind of share this with some of the audience, and then we'll see some of the feedback we get, and maybe we'll do it again in a year's time or year and a half's time and see if we it played out as we thought. So Keith and Sameer, thank you very much. We really appreciate you being on the panel. Thank you.